The AI bubble is real, and I don't think enough people talk about it.
AI, modern AI, is a horizontal enabling layer. It can be used to improve everything.
Earliest days of one of the most important technological revolutions in the history of the world.
It's the first technology that has no limit.
AI.
Everybody is talking about AI. Startups are hitting sky-high valuations, and the war for AI talent is brutal. Even the CEO of OpenAI himself, Sam Altman, has warned of an AI bubble. And meanwhile, the S&P 500 keeps climbing, driven by the magnificent 7. So the question really is, are we in an AI bubble? And if so, how close to the peak are we? But calling out a bubble isn't just black and white. A lot of it is driven by emotions. For all that we know, we could be right at the beginning of this bubble's life cycle, in the middle, or we could be right at the peak without even knowing. This is why in this video, I want to take a look at the facts. We will contrast the arguments from the bears with the arguments from the bulls. And at the end of this video, I will share my view of where I think we stand in this bubble's life cycle. Real quick, my name is Johnny. I spent the last 5 to 10 years in corporate finance and investing roles, and I created this channel to share my insights. So if this sounds interesting to you, please don't forget to subscribe, as it really helps out the channel. So the first argument from the bears is that market valuations have reached .com levels and are completely detached from reality. Let's see if this is true. One of the most popular metrics to assess market valuations during market cycles is the Shiller PE ratio. And as you can see, the Shiller PE ratio has already reached almost 40. These are levels that we have only seen during the .com peak so far. So according to this metric, market valuations are really running hot, pointing to a peak in this cycle. Let's see what the bulls have to say about that. The counter-argument from the bulls would be that the PE Shiller ratio is backward looking, but what really matters are future earnings. Take Nvidia for example. Nvidia's net income has really multiplied over the last couple of years, and only looking at the trailing PE ratio would really miss that picture. So the bulls would argue that according to the forward PE ratio, the valuations are still far below the .com peak levels. Also, this time, valuations are really driven by fundamentals, such as, earnings growth. And if we look at the forward PE ratio, indeed, the picture changes a little bit. The forward PE ratio is still below 30, and mostly driven by the tech industry, which benefits the most from AI adoption. Let's go back to the bears. The next argument is that market concentration is at an all-time high, even higher than during the .com era. And it definitely is a valid concern that just a handful of companies are making up a record share of the S&P 500. If you look at the charts, you can see that by market cap, the 10 largest companies are making up 40% of the S&P 500. This is unheard of. And with lower diversification, the systematic risk increases. If just a couple of stocks fall, then the whole index will suffer. So on the other hand, the bulls counter with the argument that concentration doesn't automatically cause market crashes. The big tech are just best equipped to capitalize on the AI technology and create value. If we compare this to the bubble in 2000, there were large companies such as Microsoft and Cisco. However, there were also a lot of small companies, just like pets.com and etoys.com, that went public with crazy valuations. The bulls would now argue that today we're betting on large global tech leaders with solid balance sheets, which is a much safer bet than during .com low. Last but not least, let's move to the last argument from the bears, which is that AI is being quickly commoditized and that only the companies that are selling the shovels are currently making a profit. And it's true. I mean, it started with OpenAI and then quickly Gemini and DeepSeek and so on. So AI is quickly getting commoditized, and let's face it, most of these companies are not profitable. Also, adoption is a lot more difficult than expected. In fact, a recent report from MIT found that 95% of AI pilots fail to generate measurable ROI for their companies. However, bulls would argue the exact opposite. They would argue that AI technology is a horizontal technology, just like electricity and the internet. It will be, used to get productivity gains across multiple industries. To say it with Jeff Bezos' words, AI will improve everything. It will be in everything.
Modern AI is a horizontal enabling layer. It can be used to improve everything.
So where does this leave us? The bears definitely have a point. Valuations are high and the market concentration currently is extreme. And it's also true that most of AI startups are currently burning cash. But also the bulls have a point. This rally is mostly driven by the top tech giants. And these are real businesses with real earnings growth. And AI has massive potential. So what is my view? I think we're not at the absolute peak just yet. I think we could be in the enthusiasm to early greed stage. I think prices are increasing, excitement is spreading, but mass euphoria hasn't totally kicked in yet. This means that there's still upside, but risk rises fast. And when a correction comes, we will probably not wipe out the winners, but the weaker players in the ecosystem. Or to say it with Warren Buffett words, if the tide goes out, we will see who has been spoilinated. But what do you think? Do you think we're in an AI bubble right now? And if so, where on the bubble's life cycle do you think we are? Drop a comment below. I would be highly interested in your take. And if you enjoyed this video, please don't forget to like and subscribe. And if you're interested in undervalued stocks outside of the AI hype, you should watch my other video up here. Other than that, see you in the next one.